I expect that the vast majority who make an investment into shares, property, managed funds or exchange-traded funds want to see the value of that investment rise fairly soon thereafter. An increase in value is, for most, validation of the decision to invest. But the reality is, no matter how good an individual investment decision may be, markets tend to rise and fall over time in ways we can't control or reliably forecast. While, for example, an investment in a particular share may see it outperform the overall share market, a widespread decline may mean that the value of almost all shares fall. For the serious investor, rather than the speculator, an investment in any growth asset, such as a share managed fund, should be driven by the expectation that over extended periods of time, the share market will rise based on both history and investment theory. However, any immediate increase in value should be regarded as a purely random event, rather than an indication of investment prowess or the wisdom of the decision to invest. And for many investors, such increases may actually be deleterious to their long-term financial health. The purpose of this video is to demonstrate that it's not only investment returns that will affect your long-term investment wealth. It will also depend on how the pattern of investment returns coincides with the availability of cash flow to invest or the need to withdraw funds from investments to fund lifestyle. A counterintuitive insight that emerges is that many young adults in the early stages of their wealth accumulation journey would be better off if investment markets initially perform poorly rather than growing at above long-term average returns. Hi, I'm John Lesky, recently retired personal financial advisor and founder of FinHealth, a tool to guide you to your financial independence. So, to examine the interaction of the pattern of investment returns with cash flow, we'll consider three patterns of returns, A, B and C, over a 25-year investment period, as shown in the table on the screen. The compound annualised growth rate over 25 years for each pattern of returns is 5.6% a year, reasonably consistent with the long-term after inflation and after-tax returns for the Australian share market. Pattern B returns reverse the order of pattern A, while pattern C assumes constant returns for the entire investment period. This chart shows how an initial investment of $1 million would grow over the 25-year period, assuming no additional investment or withdrawal of funds. Given the compound annualised growth rate for the three patterns is 5.6% a year, it's unsurprising that the end values are the same, although their paths are very different. The sequence of returns is irrelevant to end-period investment wealth in this special case. But now, let's have a look at how the timing of cash inflows and outflows alters the picture. First, we'll assume a 40-year-old couple early in their wealth accumulation journey who are able to invest $50,000 of real or inflation-adjusted savings each year for 25 years. This chart shows their investment wealth accumulation for the three alternative patterns of investment returns. Investment wealth is maximised with pattern B, where returns are negative in the first 10 years and rise thereafter. The young couple benefit from a pattern where investment return increases are back-ended, and they have a significant amount of their savings invested at relatively low prices. The opposite pattern, where investment returns are high early in the wealth accumulation journey, has them investing a considerable amount of their savings when market prices are rising. The back-end decline in investment returns and market prices more than offsets the regular savings injections, resulting in a severe decline in investment wealth after year 15. The analysis illustrates the proposition that young adults with considerable future savings ahead of them should not be deterred by initially weak investment markets, provided long-term returns remain roughly consistent with the last 100 years or so of investment history. But of course, it takes discipline to continually invest when markets are weak. Finally, we examine how the pattern of returns affects a 65-year-old retiree wanting to draw down a real or inflation-adjusted $50,000 a year for the next 25 years from an initial $1 million of investment wealth. The chart on the screen shows the results. The retiree would run out of money at year 15 with pattern B. Unlike the young wealth accumulator who benefits from this pattern, poor investment returns early in the investment period, combined with drawdowns, quickly erode investment wealth. By the time markets are performing strongly, there isn't any investment wealth available to take advantage of them. In the early years of retirement, with constant drawdowns, a retiree benefits from steady to rising investment returns to build investment wealth to withstand any subsequent weaker investment markets. The reality is that ahead of time, you can't know the pattern of returns for any projected investment period. So, what are some of the lessons for good financial health that can be taken from understanding both the timing of investment returns and the timing of cash inflows and outflows will affect your investment wealth? For investment wealth accumulators, they shouldn't be deterred from poorly performing growth asset markets. Rather, they should formulate an investment strategy that is consistent with achievement of their lifestyle objectives and stick to it, regardless of what investment markets are doing. As discussed, the times when your emotions are telling you not to invest may turn out to be the best times to invest. A preconceived plan and implementation discipline helps overcome emotions. For retirees, the lessons are probably a combination of the following. 1. You need to accumulate sufficient investment wealth to enable you to withstand prolonged periods of poor investment markets. See our previous video blog titled The Retirement Expenditure Multiple. 2. You need to hold a proportion of your investment portfolio in defensive assets to reduce the volatility of the value of your investment wealth. This, of course, will reduce your expected investment returns, but it's the downside rather than the upside you need to protect when there are no future cash flows expected. And/or 3, in response to declining markets, although it may be unpalatable, you may reduce your cash withdrawals. Finally, a clear message is that you need to understand your cash flows. Given that you can't reliably forecast investment returns and the order in which they come, cash flow is the key determinant of investment wealth over which you have the most direct influence. Hopefully, you found this video of interest. I'd like to know what you think. Please provide any comments or questions below. Finally,